Vertiv gained 2.4%, with a Moat durability score of 70, durable. As artificial intelligence clusters push rack power beyond 100 kilowatts, traditional airflow fails, making advanced liquid cooling the ultimate physical bottleneck. Vertiv controls this hardware pinch point through high-density power and circulating thermal fluid distribution. The full teardown exposes whether this infrastructure advantage holds against shifting data center designs. What operating evidence matters most for Vertiv Holdings Co? Vertiv controls the physical infrastructure bottleneck of the AI hardware expansion through high-density power distribution and advanced liquid cooling. And another question, what could weaken Vertiv Holdings Co.'s Moat durability? The engineering moat is anchored at the physical hardware layer of multi-megawatt data centers, where switching thermal management vendors mid-build-out introduces catastrophic risk of thermal throttling, rack downtime, and broken deployment schedules. Walk the AI stack, and Vertiv sits as a Tier 1 bottleneck, controlling data center power and liquid cooling. The moat here is installed base, and it should hold for long. Unprecedented demand for AI data center power infrastructure drives backlogs, though recent stock consolidation reflects near-term execution and capacity expansion scrutiny. The one force that could crack it, Schneider Electric, Eaton competition, copper/steel raw material costs. Vertiv beat earnings by 6%, 152 cents per share against 144 consensus. Management backed that surprise by raising full-year guidance on 24% revenue growth. Wall Street is pricing Vertiv as an infrastructure necessity. Temporary shipment delays aren't lost demand, they're backlog. Institutional capital is rotating from software directly into physical data center hardware. Hyperscalers cannot deploy high-density compute without Vertiv's cooling systems. The single engineering reality that validates this valuation is rack-level thermal design power. Traditional air cooling maxes out at 30 kilowatts per server rack. Next-generation liquid-cooled accelerators draw over 100 kilowatts per rack, heat that air cannot handle. Vertiv's direct-to-chip cooling loops pump liquid across cold plates attached to accelerator silicon, achieving thermal resistance below 0.05 degrees Celsius per watt. Schneider Electric markets legacy air-assisted chillers. Vertiv controls over 60% of high-density liquid cooling across Tier 1 hyperscaler builds. That physical dominance is exactly why the raised guidance sticks. Anchored in engineering, not double-booked orders. Quarterly financials showing modest revenue momentum for Vertiv. The macro tide is shifting from cheap software credit directly toward high-voltage physical infrastructure financing. The Federal Reserve holds its policy benchmark at 3.63%. Meanwhile, the 10-year Treasury yield sits elevated at 4.63%. The yield curve is normalizing with a spread of positive 0.48%. Third-party prediction markets on CalSure peg current recession risk at just 6.1%. This normalization signals a durable macroeconomic expansion rather than an imminent credit freeze. In this environment, capital is not abandoning tech. Instead, capital is rotating violently down the silicon supply chain. Money flows past chip architects and packaging lines into physical facilities. Hyperscalers must secure power distribution before buying another GPU accelerator. Vertiv sits directly at this physical intersection. It captures this spending wave, delivering 24.1% top-line revenue growth. Its earnings per share surged 53% year-over-year. Elevated 10-year yields force strict discipline on hyperscale capital expenditures. Data center operators cannot afford inefficient power delivery when long-term debt costs 4.63%. Every watt wasted in heat dissipation represents destroyed capital. Vertiv benefits because liquid cooling cuts energy overhead per compute cluster. Yet monetary policy creates a distinct friction point. High yields raise the hurdle rate for debt-financed utility substation expansions. At the same time, trade policy introduces heavy friction at the factory gate. Headlines highlight intensifying tariff negotiations targeting imported industrial metals. Copper and structural steel form the physical core of uninterruptible power systems. UPS, uninterruptible power supplies, battery-backed electrical systems providing emergency bridge power during grid interruptions. Tariff friction threatens to drive up the bill of materials across thermal management plants. Investors watch industrial metal import costs as an early indicator of factory margin pressure. When tariffs hit basic inputs, equipment fabricators face immediate margin compression. Trade policy is no longer background noise. It directly determines the component costs behind every liquid cooling deployment. Geopolitical competition has transformed data center power into an instrument of state capability. The race for artificial intelligence sovereignty requires massive domestic compute clusters. Nations view gigawatt-scale infrastructure as critical strategic assets. This dynamic accelerates demand for industrial power and thermal management systems worldwide. However, global supply chains face intense regional choke points. Precision liquid cooling manifolds require specialized manufacturing hubs and complex component networks. Any disruption across cross-border freight routes delays physical data center commissioning. Simultaneously, established international rivals like Schneider Electric and Eaton are contesting every global procurement bid. These industrial powerhouses pressure equipment pricing across European and Asian infrastructure projects. At the same time, a powerful social and political friction is emerging domestically. Gigawatt-scale AI data halls place unprecedented strain on regional utility power grids. Local municipalities and public utility commissions are pushing back against unchecked energy consumption. Communities express growing concern over the immense electrical draw of hyperscale facilities. Water consumption from legacy evaporative cooling towers also faces severe environmental scrutiny. This public pushback creates a strict regulatory bottleneck for new facility permits. Data center operators can no longer build massive air-cooled facilities with reckless abandon. This social friction directly accelerates the engineering shift toward direct-to-chip liquid cooling. Direct-to-chip cooling, circulating liquid coolant through cold plates mounted directly on processor dies. Liquid cooling removes heat far more efficiently without consuming local municipal water reserves. It packs higher compute density into smaller physical footprints, easing local grid friction. Monetary discipline, raw metal costs, and grid constraints act as constant friction. Yet sovereign AI demand and thermal physics act as overwhelming forward accelerators. Vertiv operates in a rising capital expenditure cycle with long runway ahead. Its order backlog proves that hyperscale infrastructure buildouts remain structurally intact. Vertiv power cooling is trending higher at 293.84. Vertiv's quarter isn't about operating leverage. It's an operational stumble buried inside a glossy headline. Strip away the PR, and the earnings call transcript tells the real story. Physical capacity constraints killing revenue recognition. Wall Street expected $100 million more in top-line revenue for the quarter. When analyst Amit Daryanani pressed CEO Giordano Albertazzi on whether supply chain disruptions caused that miss and whether internal bottlenecks were larger than reported, Albertazzi dodged the precise dollar exposure. On the Vertiv side and the exact amount, I will not be too specific. Giordano Albertazzi, CEO, Q2 2026 earnings call. That refusal to quantify is the tell. What Vertiv is saying, this is a learning curve around large project deployments. What the lab hears, management is actively framing a fulfillment bottleneck as routine customer scheduling. When a chief executive refuses to put a dollar on internal delivery delays, he's rebranding internal supply chain congestion. Albertazzi described the disruption as confounding effects from both external suppliers and our internal supply chain. What management calls a sequencing adjustment, the numbers reveal as a physical fulfillment bottleneck. Hyperscalers building multi-gigawatt facilities cannot power up high-density racks without completed power and cooling units. The $100 million revenue push-out represents hardware sitting in manufacturing queues rather than shipping to job sites. Factory floor execution, not market conditions. Executives aren't dumping shares. They're also not stepping in with open market purchases to signal confidence in operational throughput. No confidence vote here. Management wants Wall Street focused on full-year revenue targets of $14,000 million rather than quarterly factory floor execution. Underneath the optics sits undeniable financial strength. Institutional positioning shows high conviction backing as of 13F disclosures. JP Morgan Chase increased its stake 66%. T. Rowe Associates added 17%. Even Geode Capital's 17% trim signals selective positioning, not retreat. Short seller activity sits at 50.7% of daily volume, holding steady against its 54.3% baseline. Institutional bears aren't actively shorting this supply chain delay. The real signal lies in language shift. Risk disclosures contained baseline language. Release added growth 11 times and guidance 8 times. Management escalated its PR vocabulary to swamp questions about component delivery friction. In the Q&A, analyst Nicole DeBlaise pressed for clarity on how much second-half revenue relied on resolving this learning curve versus new capacity expansion. Management pointed to a very strong backlog coverage and asserted that second-half guidance is not an all-stars-aligned type of outlook. Giordano Albertazzi, CEO, Q2 2026 earnings call. Internal factory throughput is lagging hyperscale build-out velocity. That gap creates delivery exposure when input costs like copper and steel inflate raw material expenses. Go straight to the MD&A section and track gross margin. That's where internal capacity friction reveals itself. The momentum breakdown for Vertiv. RSI sits at 52, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. Vertiv controls the physical infrastructure bottleneck of the AI hardware expansion through high-density power distribution and advanced liquid cooling. The engineering moat is anchored at the physical hardware layer of multi-megawatt data centers, where switching thermal management vendors mid-build-out introduces catastrophic risk of thermal throttling, rack downtime, and broken deployment schedules. Yet, even dominant physical layer moats face severe mechanical and economic limits. Vertiv's premium valuation, with a trailing P/E sitting at 66.6x and a forward P/E at 32.3x, leaves zero margin for error when manufacturing friction occurs. At the same time, heavy industrial competitors Schneider Electric and Eaton are actively contesting Vertiv's power and cooling market share. Institutional positioning highlights this divide, standing 13F. Filings from show conflicting institutional conviction, with JP Morgan Chase & Co. adding plus 66% and T. Rowe Associates increasing holdings by plus 17%, while Geode Capital Management trimmed minus 17% and Vanguard Midcap Growth reduced its stake by minus 9%. However, if internal assembly delays persist, hyperscalers building gigawatt facilities will multi-source physical hardware from Schneider Electric or Eaton to avoid delayed data center commissioning. Following its recent earnings announcement, Vertiv's post-earnings setup establishes two distinct operational scenarios for its structural moat. If internal supply chain friction continues to push out fulfillment schedules and cause revenue deferrals, it will reveal that execution bottlenecks are actively eroding market share to competitors with ready manufacturing capacity. The single-sourced metric that will distinguish these outcomes is quarterly operating cash flow stability relative to backlog realization rates. Options flow displays a bearish put-to-call ratio of 1.64 with ATM4. At 55.6% pricing, a plus or minus 6.5% move. Here's the macro picture shaping Vertiv. Proposed U.S. tariffs on foreign steel and electrical components threaten to raise manufacturing costs for Vertiv's cooling. Vertiv sits at the absolute epicenter of data center thermal and power architecture, operating at the peak of the hyperscale infrastructure cycle. In their filings and earnings calls, management aggressively frames the story around recurring services, closed-loop liquid cooling, and full powertrain solutions like OneCore. However, engineering reality shows execution friction, multi-phase deployment complexity, and supply chain congestion pushed second-quarter revenues into the back half. The lab sees full-year guidance raised to $14 billion against 84.6% institutional backing. Yet the market has priced perfection into a 66 trailing multiple. Over the next 2 quarters, Vertiv must prove it can convert this massive backlog without further margin dilution from tariff friction. VRT's 200mm wafer bottleneck just crushed Wall Street's margin forecasts. That's core signal. Which engineering constraint most threatens Vertiv Holdings Co.'s moat? Give us your evidence. This is The Lab, educational content, not financial advice. Markets change. Past performance doesn't predict future results. Always do your own research before trading. Hit subscribe for the next engineer-level breakdown. If you want our full breakdown on NVIDIA, the link is in the description. Stay precise, stay profitable.